The S&P 500 just surged 16% in 25 days, zero pauses, zero pullbacks. Is this rally built to last, or have markets gone too far too fast? Buckle up, because what happens next might shock everyone. Let's jump into these charts. S&P 500 down almost 60 S&P points in the pre-market. The surge that we saw from the swing low that was established back here in April that led to this 25-day rally that basically saw 850 S&P points, about just over 16% in pretty much a straight line fashion. And the thing is that it's not that it has to somehow be immediately bearish, but when a market makes that big of a move, it often has a correction. So let's just kind of go back and look at the second half of last year, and what you can observe is that any time we're like 300 S&P points above the 50-day moving average, like you see on several occasions over here, let's say, you can, or even over here, you always have some sort of a mean reversion that returns back to the 50-day moving average. And this is at some point something we can expect, and this week would very much fit the bill for something like that, where we kind of pause, throw back a couple hundred S&P points just to revert back to the moving averages before a market can set up for what could potentially be another bull advance. Now, generally, up until about last week, we have been bearish this market, and the narrative of this being a bear market rally, where you don't really abandon that view, in a sense that I think the recession risks are still very real. I still think that all of the vulnerabilities in the market, the monetary cycle, all of those things are still evident. But what we did have happen last week was the sell cycle was neutralized, which basically punts and pushes forward the time frame from which the market can break down again. The likelihood now that we spend the month of May and June in this kind of like holding pattern up along last year's highs is entirely plausible. And so if I was to give you a scenario of how I think that it's going to play out, is we have a pause here in the market, a subsequent rally, and then probably sometime in June or maybe July, maybe it's the July earnings cycle, maybe it's the June or July jobs numbers, but something at some point is going to be the kind of wrench that's thrown into the gears that kind of seizes things up. But the likelihood that it happens here in the month of May is a very small window. So the thing that I want to highlight is investors generally should be skeptical about panicking if we have this 100-point down day. Like if we have 100, 120 points, that doesn't mean that the market, floodgate is open and then it's just going to sell. Odds are that it will be bought on dip, and that's what we're going to watch as it approaches that 50-day moving average. Overall, I will probably get much more bearish this market going into the tail end of the second quarter, but right now this is the setup. Okay, so let's move on. The dollar index continues to deteriorate. We have a dollar breakdown that is essentially setting up for some sort of a double bottom retest of its lows, with failure at the 50-day moving average was right at the Fibonacci zone. So this is still a prevailing downtrend, and all of the entire bounce in the dollar can only be categorized as a retracement of the prior downtrend. And so before we start looking for a short-term low, it's like the 98 level on the dollar index is a logical level where the lows should hold for several months. And so at this stage, I'm thinking that the most probable scenario is that we're going to see like a double bottom retest here. So it's going to come down, retest 98, spook everyone again, maybe even temporarily break to a lower low. But I don't put a high probability to a full breakdown where we go like to the 95 level. Generally, this is a zone where it's very likely that we're going to see a consolidation in there. That doesn't make me US dollar bullish, because I don't necessarily think that that means the dollar index is going back to 110, but rather that I would be skeptical of going aggressively short the dollar here just because it's breaking down. Expect this to be far more range bound in this area. Okay, so Let's talk about precious metals. Gold up $50. We've been tracking this with all of you on the on whether on the YouTube channel or whether on our macro outlooks at the membership. Right now with gold, it's still holding this 50-day moving average, and it's still above this Fibonacci zone. And so we still can give the bulls the benefit of the doubt that they're going to be able to break this out. But let's talk about key levels. And the key level now is, if I put this on a 4-hour chart, is whether or not this thing could beat the upper zone or just above 3,300. And so what we're looking for is some sort of bullish follow through here on the upside that clears 3,300, 3,350, so that the bulls can gain some sort of momentum on the upside for what would be defined as a breakout. If that happens, then still the 36 to 3,700 targets would be completely in play for a bull advance. We've continued to watch carefully because this 3,200 remains our like fulcrum point of whether or not this is a short-term buy on dip, or whether gold has entered a longer term, not longer term, a more intermediate term, like a multi-month correction that could see 3,000 or 2,900 on the downside. So at this moment, we'll watch this consolidation, and this is a key area. So far, it's holding. So let's give the bulls the benefit of the doubt for this until we see some sort of failure trigger point that says that that's no longer the way that this is going to play out. So right now, we're still giving the bulls the benefit of the doubt. Crude oil. This is actually a really important moment in crude oil. I love it when we have a sell-off like we did on Thursday of last week, because now that we've seen what could potentially be a double bottom in crude, the key to this pattern will come of whether or not it stops making lower lows. If we see that this holds generally above $60 during this pullback, then we're going to be talking about this anchor as a base from which we could break above that 50-day moving average and actually see some sort of a new rally get underway. Now, the entire thesis of crude oil breaking down had so much to do with recession risks and global economic slowdowns. Now the stock markets have pulled that scenario, or at least lessen the probabilities of it. The question is oil deserved to stay down here? Obviously, so much of the bad news has already been baked into the cake, and so we're going to be seeing whether or not we can see bullish constructive price action start to emerge here. Now, let's move on here. I just want to touch on a couple other quick little commodities. First of all, the U308 is at 71.55. Like, uranium continues to work. What will be interesting is there's headlines about Germany changing their uranium policy, or sorry, nuclear plant policies. Will this be a bullish tailwind for uranium in this week? Will be a really interesting thing, and I think all of our listeners should be watching for. We've been generally turning bullish here since we've got back above the 50-day moving averages, and generally seen good bullish constructive price action. So if this creates a positive feedback loop, then we may have a new bull trend forming here that all of you need to pay attention to, because it's been a 1-year face-ripping correction in uranium that has left all of the uranium bulls quite disheartened. And at this stage, so many people are skeptical of this, but this is how often new bull phases begin. And I think that if this continues to develop this way, this is a first or second inning entry in what could be or what is developing as a potential new bull phase. So let's see how that uranium story develops. The next thing I wanted to just touch on is the interest rate market. And so now, whenever as the recession risks have lessened, at this moment, they pulled almost 25 basis points, almost 50 basis points of rate cuts out of the market next year. So this is a December 2026 SOFR future. To me, this is absolute no-brainer level to be watching. You are at a situation where well, think about it this way. What would have to happen in order for the Fed to raise interest rates and throw a massive curveball into the markets? Well, it would have to be, let's say, runaway inflation or some other kind of really hot numbers that has them concerned of having to put the brakes on. What probability do we assign to something like that? Very small. And so at this moment, we're pricing in essentially 3.5% interest rates out to next year, which is basically putting, let's say, 75 basis points of cuts in the next year and a half into this market. Now, that to me defines pretty much the downside risk to this. I don't think that we're going to see interest rates go higher. So the downside risk is basically to the January low. But yet at the same time, if anything goes wrong, and the Fed has to pivot dovishly and start providing liquidity and cutting rates, the upside from here is 150 basis points or more. To me, this is an incredibly asymmetric trade that is totally worth putting on. I'm using option strategies like split strike synthetics in this to try to take advantage of this pullback, because it's not that it's guaranteed to work, but it's incredibly asymmetric in the fact that if something does go wrong, you have all of that upside, and the downside risk is pretty much defined unless some crazy outlier was to occur. And when we're talking about the long bond, continues to sell off. So we have, this is the long bond. The TLT will start off the morning pretty weak. We're at a major low right now, testing a key support line. Now, if the measured move on the long bond finishes, you have a scenario where it can head all the way back to the lows of the bond bear market of 2022-23, which was down along this 108 level on the long bond. This is an immediate downside risk. Interest rates could go higher, and this could ultimately be the catalyst that drives stock markets down in a correction. Because when we have a breakout in yields and a breakdown in bonds this way on the long bond, it's going to cause nervousness in the market, and that could be what the market pays attention to when there's such a lack of economic data coming out this week. This could become the focal point as we move forward. That's your macro outlook. Have a good trading day.